I'm going to show you a chart that is going to shock you. Tesla stock is down 33.3% in 2024, and GM stock is up 25.3%. Yes, GM is outperforming Tesla by 58.6% so far in 2024. And there's actually good reason behind that. The catalyst that drove Tesla to the valuation that it has, particularly during the pandemic, high margins, high growth, have really started to reverse. This is no longer really a growth company. Manufacturing growth out into the future with new plants like the Mexico plant are starting to be delayed. Margins are coming down. That was really predictable 18 months ago when they started to discount vehicles, but we've seen margins just collapse over the past year. And now this is looking like a pretty normal auto manufacturer. Meanwhile, GM just continues to do what it does. It just sells trucks and SUVs at high prices, generates a reasonable margin, not particularly profitable compared to other competitors, but it generates solid free cash flows, expecting to generate more free cash flow this year. And it's starting to buy back stock really aggressively. So you add all of these things together and investors are looking at where's the opportunity, and they're seeing more opportunity in GM stock today than Tesla. So I'm going to dig into that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's first look at what has gone right at GM, and then I'll talk a little bit about Tesla. The first thing I'm going to show here is the free cash flow at General Motors. And you can see that over the last decade, this has just been a cash flow machine, despite the fact that GM has been consistently generating free cash flow year after year. The company's market cap is only about $52 billion. This is even after the run up in the stock recently. So what management has done is they've said, all right, fine. If we're going to only have a market cap that's 5 or 6 times earnings, which is where the stock trades today, then we'll just buy back our stock really, really aggressively. Here's a look at GM's weighted average shares outstanding. Since the middle of 2022, you can see that the total changes down about 10%. But this actually doesn't tell the full picture. Shares outstanding was only about 1.2 billion as of the end of the fourth quarter. This is weighted average shares outstanding. So it's going to be an average throughout the quarter. They did a massive buyback program at the end of November in 2023. So we are not going to see this in this weighted average number, which is what a lot of places report, until the first quarter of 2024. Management said that it's very possible that they'll get to about 1 billion shares outstanding by the end of this year. Now let's look at 2024 guidance. Is this cash flow going to continue? And the indications that we've seen so far is absolutely. $8 to $10 billion in auto-adjusted free cash flow is what they're expecting. And EBIT adjusted, or earnings before interest and taxes adjusted, is expected to be $12 to $14 billion. This is even after investing $10.5 to $11.5 billion in capital expenditures and their battery joint venture. GM isn't a growth story, but it is a value and a shareholder return story. So the company is just going to continue to generate cash, building trucks and SUVs that people want to buy, ICE vehicles in particular. They've delayed a lot of their move to electric vehicles. They've reduced spending at Cruise, and that's going to leave more and more cash to do this massive buyback program. And it looks like they're on pace to buy back 15 to as much as 25% of shares outstanding each year over the next few years, if that's what they choose to do. Management has said that they want to keep a cash balance of right around $20 billion, but they continue to generate cash, so they'll be able to buy back shares at a really aggressive rate. And that's exactly what's happening at GM. There's nothing more complicated than that. There's no massive announcement that's happened in 2024. It's just a shareholder return story. And that's something the market is really cheering. At Tesla, the story is a little bit different. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The first chart I'm going to show for Tesla is trailing 12-month revenue. And what trailing 12 months does, it just takes away some of the seasonal volatility. But you can see that revenue growth has really stagnated over the last 3 months. There's a couple of reasons for that. One, the number of vehicles is being sold is not growing at the pace that it was previously. I think it's pretty clear this is because demand just simply wasn't there at their old price point. So they have pulled back on some of their capacity expansions, particularly in Mexico. That's been delayed for kind of the foreseeable future right now. And also prices per vehicle are starting to come down. So you add those two things together, you start to see slowing growth, and we may actually go to negative revenue comps in the first quarter. If a stock is trading for 41 times earnings, which it is today on a trailing basis, 59 on a forward basis, investors are expecting a lot of growth from that company. And if that's not what we're getting from Tesla, Tesla's shares are going to drop because stock prices are based on expectations of future results. So if the expectation is this is no longer a company that's going to grow at a 50-pound compound annual growth rate, that was what Elon Musk laid out a couple of years ago, was they were going to increase deliveries 50% per year. He's really backed away from that. So it doesn't seem like they're going to grow anywhere near that. And the competition in the EV space is just getting stronger. So revenue growth is starting to slow, and margins, I think, is a bigger story. This is a look at gross margin in red and operating margin in blue. And again, I did these on a trailing 12-month basis. So it takes out a little bit of the seasonality and some of the lumps from price changes, but you can see that the trend is really clear. And what I think we need to look back on with Tesla is that Tesla was one of the companies that was raising prices really dramatically during the pandemic. At the same time, they were also growing their production. So kind of the mess ups that happened with the traditional Detroit companies where they were limited on supply, took a lot of supply out of the market. There was excess demand. Where did that demand go? Well, it went to the one company that was actually increasing their supply, and that was Tesla. They were able to raise prices and increase production. That's where you get to the gross margins that peaked in the high 20% range. But that's not where we're going to end up long term with a traditional automaker that has built at scale. There are some automakers that have really, really high margins, but they're companies like Ferrari who have a really, really constrained supply base. But a major company like Tesla that's producing millions of vehicles, typically you're going to have operating margins that are going to be in the single digits. And that's exactly what we see here, 9.2% operating margin over the past year and on the decline. You can spin this all kinds of different ways, but I think the obvious story is that there is more supply than there is demand for Tesla's vehicles. That's resulted in lower prices and lower margins and slower growth. If we also look at free cash flow, this is again free cash flow on a trailing 12-month basis, gone from almost $9 billion a year in free cash flow in the middle of 2022. And then they started cutting prices at the end of 2022. That was really when the first price cuts and incentives started to happen in December of that year. Now free cash flow, $4.4 billion and on the decline. So the trend here is pretty clear for Tesla from an operating perspective. They're feeling a lot of pressure from competitors in the EV space, from increased supply, from traditional ICE manufacturers, and some of these promising products that could potentially add revenue and margin in the future, like FSD, like Dojo, like energy products, which are growing pretty significantly, haven't really started to impact the business in the way that would justify a market cap in excess of $500 billion. So that's really what we're seeing with Tesla, is that it's just not living up to that really, really high valuation that the stock got to during the pandemic. And that's why we're starting to see things pull back. When your stock 10X in value, you have to 10X the performance of the company. And that's absolutely not what we've seen from Tesla over the last year or two. So where do these two stocks go from here? I think we're going to see more of the same in 2024 and even in 2025. I think demand for electric vehicles, yes, is growing overall, but I think Tesla's market share could potentially decline this year and next year. We'll see what delivery numbers look like for the first quarter. Those are not out as the time that I'm recording, but we're seeing more and more competition, not only in China, but also here in the US. Also, demand for vehicles overall seems to be just kind of generally slowing down. That's pushing down margins. The strange thing for GM is they're a little bit insulated for that. If you remember during the pandemic when prices were absolutely crazy, a lot of that price increase came from dealerships. So dealerships were marking up their vehicles higher than MSRP. So as the market has gotten back to more of an equilibrium, those premiums have come down. That has impacted dealer margins, but has not impacted GM's margins to the same extent. Tesla, the same thing happened. They increased prices, but Tesla doesn't have third-party dealerships the way that GM does. So they're feeling the entire pain of the change in sale prices or sticker prices for vehicles. So something to keep in mind there in the dynamics between these two companies. But I think the trends are really clear. Tesla is just not living up to be the phenomenal growth stock that a lot of investors expected. Looks a lot more like a traditional auto manufacturer, and auto manufacturers trade for 5, 6, 7 times earnings, not 50 to 100 times earnings like Tesla was trading for. So that's why we're seeing the stock pull back. That's why GM is outperforming. And I think if the company continues to buy back stock aggressively, could be an outperformer compared to Tesla for the next few years. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.